Alphabet, more commonly known as Google, just reported Q3 numbers and Wall Street was not happy about it. The business missed on their earnings estimates, which, after reporting a weak quarter by their standards, sent the stock down about 6% after hours. So, is this a value investing opportunity to profit off of Wall Street's short-term mindset, or should we be dumping this stock too? Stick around because we'll talk about all that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. In this video, we will be talking about the fundamentals, the top line, bottom line, balance sheet, cash flows, providing an analysis, and finally concluding with an evaluation of this business using our intrinsic value calculator, which is going to identify for us the buying opportunities with Google and whether or not we can purchase this at a price of value. If you enjoy this type of content, we post this regularly on this channel, so please subscribe, like the video, and without wasting any more time, let's jump into the video. Okay, starting with the comments from the CEO. They said for this quarter, they're sharpening their focus on a clear set of products and business priorities, and that the product announcements they made just over the past month have shown that they're very clearly and significant improvements to both search and cloud powered by AI, and with new ways to monetize YouTube Shorts, and that they're focused on investing for the long term while also making sure they're aware of what's going on in the macroeconomic environment. Okay, so they're focused on investing for the future right now. We've seen they've been able to historically produce revenues at a growing rate, and the same thing with their bottom line. They have been able to grow this as well, and they've also outperformed the market for the most part as well, but not as much as you might like from a business like Google. So that leads us to our statements of income. For this quarter, they were able to produce about $69 billion in revenue, cost them $31 billion to produce that revenue, and then when you add on their costs of research, development, sales, marketing, SG&A, etc., they have total costs and expenses of $52 billion. We're left with $17.1 billion operating income. So the margins are still there, but when we compare this to a year-over-year perspective, yeah, we've actually produced less income from operations. That's because the cost of revenues, along with all their other expenses, are increasing at a higher rate than the revenues have been able to increase. And so ultimately, we have a negative impact to the bottom line. If you dive a little deeper, we can actually see what's going on though. And if you look at this from a constant currency perspective, in terms of their EMEA revenues, those are actually up 11%. APAC revenues are up 8%. Other Americas is up 17%. And then revenue from the United States is up 12%. So obviously the Forex impairments have really hindered this business and is the reason why they ended up missing on their estimates. And as we already know, Wall Street is extremely short-minded. They need to perform quarter over quarter for their clients, which actually gives us value investors an opportunity to pick up great businesses at discounts. And this might just be that opportunity. As you can see, total revenues here of $69 billion, that was a 6% increase. But ultimately, when we look at this from a constant currency perspective, it was an 11% increase, which is still some solid growth overall. Now, if we look at this from their balance sheet, we have $139 billion in cash, then $14 billion, let's call it 15 just to round up, in debt. So they have a ton of cash just sitting there on the balance sheet. I mean, there's so much that they can actually do with this and service the shareholders even further. They can improve the business by making acquisitions and such, or even better, if they really want to return shareholder value, they could start using this cash reserve to start helping pay out a dividend or something like that. But for right now, they just have a lot of it sitting there on the balance sheet, not really doing anything with it. So that leads us to our reconciliation of net cash provided by operating activities here of $23.3 billion. Deduct our capex, and we're left with $16 billion in free cash flow for this quarter alone. Awesome numbers right there off the bat. What are they doing with that to service the shareholders? Well, it's clear that they have a main focus here, and that is to repurchase shares, as they use almost all of it on buying back stock-based award activities, and then they've leveled out their debt position as well. So with all that in mind, that leads us to our intrinsic value calculator here. And because they're buying back so many shares, we're not going to use our EPS calculator, although it does make things a little simpler. Instead, we're going to look at the value that they can create for shareholders quarter over quarter. Right now, that's about $16 billion in free cash flow. If we extrapolate that out over the year, we can reasonably estimate that they can come in with about, let's call it $65 billion in free cash flow by the end of the year. If we require a 10% return, right now they're not paying a dividend, although they do have the cash for it, and they can continue to grow at 11% for the next 5 years, and then that drops down to, let's just call it about 7% for the 5 to 10 years after that on a 20 PE like they're currently trading at. This stock is worth about $1.2 trillion. Right now, they're trading at about $1.3 trillion. So we can reasonably say they're trading sort of at a margin of safety investment point right now. Now, in the very best case scenario, let's say they can actually start to grow closer towards these 5-year EPS growth numbers here of 32%. Let's just say it's 25% because it's a little more conservative. Then that drops down to about 15%. On a 25 PE, the stock could be worth $3.7 trillion. So huge upside in the best case scenario. But in the very worst case scenario, where they have further forex impairments, their tailwinds subdue, cost to produce their revenues increases, etc., they can only grow at about 5% for the next 5 years. That drops down to 3% for the next 5 years after that. On a 15 PE, the stock is only worth $600 billion. And that's exactly what happens with these growth stocks. When the growth slows, it severely impacts the stock's price and the stock's weighting. And that's clearly what we've seen across the board, especially with stocks like Google. We've had a severe pullback so far. Of course, there are macroeconomic challenges worldwide, but you have to ask yourself, if this is a potential investment for you, what does the future look like for Google? Are they going to start to grow again at, 30, 40% per year? Are they going to start to grow at a slower rate, maybe at 10% per year now? Or do you think that the growth is going to start to decline? I mean, I think that's personally a little bit unrealistic here. Google is a huge conglomerate and they have almost a monopoly on the search engine space with the Google and YouTube coupling. But let me know your thoughts down below on where you think this stock is going to go. Personally, I think the lower the better for this stock because it will bring itself down to a more feasible buying position. But that's my analysis on Alphabet. If you enjoyed this video to this point, please like, subscribe, and I'll catch you on the next one.